Greetings, salutations, and howdy to you all. I'm KT with Atocha Global Analytics. As always, wish to remind you, Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate, and finance trends, and the policies that shape them. So welcome back to Forecast Friday. This is our once weekly segment, and this is the Friday, August 18th, 2023 edition, slightly delayed due to the medical emergency of a household pet who is doing much better now. But here comes the latest from here and around the globe. So it appears that the whole planet has an economic flu, and the U.S. has been able to avoid the economic ills that we're seeing elsewhere, at least to some degree. This week's Forecast Friday tables, the update there, really, it's looking more green than red at this point. We've definitely seen some improvement, but one data point is either shockingly or laughingly good. Some data, when it changes in unprecedented ways, is more telling in more ways than just one. And so today we're going to unpack a few things that are of note and show the latest table data, and specifically mention this one metric and do a little bit deeper dive. So first thing is a huge story of this week. Fitch has been a tear recently. They downgraded the U.S. credit rating. Now they've turned toward the banking sector and confirmed the obvious. There's challenges in banking, and it really warrants raising red flags of the increasing risk that we're seeing. Fitch cited three main motivators for their moves. Higher borrowing costs, of course. Interest rates went up. Surprise, surprise. Possible capital shortages. That's also a no-brainer because they've changed the lending requirements, reserve requirements, and deposits are down. And the third is outstanding loans in commercial real estate. And they, of course, noted that they see that sector as being in a nosedive. So clearly, these are all issues that are stemming from the rapid transition from a zero interest rate environment into what has been a more historically normalized interest rate environment. And it's not the level, it's the delta, the change that's a factor here. So anyway, Moody's also added to this by lowering the book value of banks by 15% due to low interest residential mortgage sitting on their books, just as an aside, though, the second quarter 2023 earning reports for banks show an improvement over Q1. It really is improving in some ways, but these factors are still drivers. And finally, by the way, Fitch put out a warning that it could cut the rating on some big banks also. So, those big banks, including Bank of New York Mellon, State Street Bank, Truist Financial, and U.S. Bancorp. So, but here's a list of the banks downgraded so far. A couple of them may be familiar to you. Most of them may not. Commerce Bank Shares, BOK Financial Corporation, M&T Bank Corporation, Old National Bank Corp, Prosperity Bank Shares, Amarillo National Bank Corp, Webster Financial Corporation, and Fulton Financial Corporation. So to just put it, kind of summarize this, it's understandable, and there's a good reason why the banks are having problems. Again, lack of deposits, lack of loans, lack of deals. So they're focusing on the loan issue. And by the way, a recent story entitled "Commercial Real Estate Lending is in a Logjam," according to the Mortgage Bankers Association. That article tells the tale. According to the article, commercial real estate was off 53% in the second quarter of year over year. And prognosticators have been calling the commercial real estate issue correctly for a while. I released two videos in 1 week that address this issue. The first is the office broad sector August update that tells how recent trends are manifesting in the marketplace. This expands on the office case study I created that showed the performance of a property throughout the Great Recession, how it parallels with now. By the way, just a little inside baseball. The theme of these updates is because, all the second quarter 2023 data reports are coming out right now. So we have great and timely information to release. So, by the way, similar to the office sector, I just posted a video entitled Multifamily Sector August Update. And that tells how, recent trends are manifesting in the marketplace there. And this update, it expands on my video series entitled Professional Investors Real Estate Success Story. In this series, it covered cradle to grave, the modeling, acquisition, and sale of a 232 unit apartment complex that earned nearly 20% annually based on that acquisition and sale. And then it expands, the series expands on that and shows how the buyer of the property from the firm I was with later sold it, generated a profit exceeding 25% annually. So it's two consecutive home runs, say a home run followed by a grand slam home run for the same property. So, there's great stuff here, and these are, this is a shameless plug for what was brought to you by Atocha Global Analytics, but it really is very, very insightful. So back to the real estate news a bit. Before I show you what's down with commercial real estate and lending that is shaping our economy and is something to pay attention to, please like, subscribe, and ring the notification bell for us. So, commercial loan originations, including multifamily real estate, were down 53%, as I noted earlier, but they actually increased 23% from the first quarter of 2023. So it's a slight improvement from abysmal, basically. The story notes that they expect things to break loose in coming quarters, so they don't expect it to stay here. That makes sense, of course, but the economy and interest rates will have a significant impact on how things will unfold. Finally, some noted loan types. They stated healthcare loans are down 74% year over year. Retail and industrial loans are down 55%. Multifamily loans down 48%, and hotels down 32%. So significant drop in loan volume. Meanwhile, office vacancies hit a new national record of 13.1% in the second quarter, and around 1.5 trillion in commercial real estate debt will soon be primed for refinancing, which could mean an increase in distressed properties and further undermine commercial real estate prices. By the way, Capital Economics, with it from the source from these articles that I'm referencing today, estimate that this could precipitate a 40% decline in the commercial real estate market overall. So, but anyway, meanwhile, let's talk a little bit more about lending. A slew of banks are trying to get out from under these risky commercial real estate loans, really. Not just the regional banks, but lenders like JP Morgan, Goldman Sachs, and Capital One. These are all holders of some level of commercial real estate loan debt. Clearly, this all provides systemic risk because it is large enough and broad-based enough, but it is also a wet blanket on economic growth when lending is hindered. If the banks pull back, if lenders, and even non-banks, pull back and aren't willing to lend on real estate, then they aren't lending on other things as well, and it's a problem. So this could become a really huge problem over the longer term. And everybody is braced for something to break and a recession to hit, and so that's why these banks are reticent. But the numbers are not really providing reliable guidance right now. So we have to wait and see when the economy actually reacts, because that's what the sources of capital and everything from your business lines of credit to residential to commercial, these things are all being impacted right now. And yet again, I have to remind you, DC is spending huge right now, and that will keep the GDP strong. Well, the gross domestic income remains negative or well below inflation. It's tepid. But a little bit more on the real estate and lending front before I move on. So in the second quarter of 2023, U.S. banks noted $18.9 billion in losses, which is the highest since the worst of the pandemic challenges, 3 years ago or so. It's up 17%. The increases or the losses have increased 17% from Q1 and up 75% year over year. So it's a significant increase. And about 56% of those losses were from credit cards. So credit card losses are up huge. And about 6.2% of that was from commercial real estate defaults. So it's commercial real estate still has some room to grow, so to speak. But the fact that credit card losses are up also spells bad for the consumer, just as an aside. But new commercial bank lending on commercial real estate with originations down 53%. We really like some more context there, I think, because it's not just banks, it's other sources. So combined lending for commercial real estate, including the multifamily, from all documented lending sources is expected to be 38% lower in 2023 than it was in 2022, down to about $504 billion overall. A couple prime sources of capital from mortgage real estate investment trusts, or MREITs, one from Blackstone Mortgage Trust and one from KKR Real Estate Finance Trust. They originated $0 in loans in 2023 so far. And these are some of the biggest private lenders, non-banks lenders that are operating out there. So they turned off the spigot completely. Starwood Property Trust is another key private mortgage source for this space, and they throttled back in 2022 and have no plans to ramp up lending anytime soon. In context, MREITs, usually do about $10 billion per quarter, so they are a smaller source of capital, but they aren't the only private capital that's been backing off. Other private capital and equity sources are way down. Per MSCI Real Assets, all forms of commercial real estate purchases were down by $83.6 billion. And borrowers, with the lower interest loans on commercial real estate, they're retaining, or you could call it hoarding, those low interest loans, just like homeowners currently are. So all said, commercial real estate is highly stressed and possibly a ticking time bomb. So it's very much a concern. Okay, that covered the commercial real estate portion of the segment, but now we need to circle back to the international pressures, which I've covered for a number of weeks here on Forecast Friday and done some unique videos for. So Europe has been grappling with the banking and bad debt issues, inflationary pressures, and the impact of all this is increasing tensions within the population over there, by the way. Lots of potential catalysts there for unrest and systemic problems, and the risk is quite high, and the challenges remain. But China seems to be where the press has decided to focus now after months, literally, of ignoring it. So like we've noted here, China has serious issues, from deflation, falling exports, falling imports, to lower domestic consumption, and a massive property crisis that is really approaching critical mass right now. And I've covered a number of these things before, so I'm only going to focus on expanding some things. By the way, China right now, they have a national debt totaling about 282% of their annual GDP, and that's 2.5 times what we've seen here in the U.S. for the national debt. So they're way, way worse than the U.S. as far as being burdened with debt. So Beijing, they have less ammo, really, to fight these issues. So we'll have to just wait and see what they do and what they can do. I can tell you what they've done, though. This week, the People's Bank of China decided to lower their rates by 3.5%. And that's a massive move. That's the equivalent of our Federal Reserve making that kind of move. So that's a massive, massive drop. And it's done to devalue their currency in an attempt to spur exports. Desperate measures at this point. It really does smack of desperation. By the way, just before I started this video, I opened a browser window to find that 3 out of the 12 stories tied to the property that popped up on my feed, they were all tied to the property crisis in China and the decline of the Chinese economy. So I'm glad to see the media is catching up to what we've been noting here for months, but it is very much a concern. And so anyway, now there is no sense of imminent black swan event right now. It's not a matter of that, but the aggregate pressure on the real estate sector there is getting historically high. A recent article entitled "Explainer Country Garden: How Bad Is China's Property Crisis?" They note news of missed payments on investment products by leading trust firm Zhongrong International Trust Company highlighted the outsized exposure of China's $3 trillion shadow banking sector to the private property sector. Increasing defaults by developers had already raised Chinese banks' non-performing loan ratios to 4.4% at the end of last year from 1.9% in 2020, Moody's said. But the market experts generally do not think China is on the brink of a Lehman moment, with with one company's failure cascading onto a broader financial collapse. So, we have banks, shadow banks, and other sources of capital for real estate all being crippled at this point. The interest rate moved by the People's Bank of China. It's max of desperation, if not panic, to boost the overall economy. But it doesn't really stop there. According to another article entitled China's Property Crash is Becoming More Dangerous by the Day, we see a lot more detail on this. This story noted that Kai Fong, a rate setter at the central bank, has called for a 550 billion blast of helicopter money, or a high-powered quantitative easing injected into the veins of the economy in order to stop a deflationary psychology taking hold as frightened households retrench. So that sounds a lot like the 2008 style actions taken to support the U.S. economy back then. Though deflation wasn't really a real issue here, despite the falling values of housing and other real estate. I wasn't the only one thinking these actions seemed familiar, as the article noted it this way a little further down. It says, this increasingly feels like a make or break moment faced by the U.S. Treasury in 2008 after Lehman Brothers collapsed, or faced by the Eurozone in 2012 when the doom loop threatened to engulf Italy and Spain. However, the firm Nomura noted the issues with the real estate markets and the impact on the economy in the most concise way here. They said here, the buyers have dried up in real estate. The CRIC Research Center says sales in July by the top 100 developers were just 30% of levels 3 years ago. We believe the Chinese economy is faced with an imminent downward spiral, with the worst yet to come. Warning that half-hearted tinkering by the authorities so far will not stop a wave of defaults and chain reaction through the economy. And here's a more direct quote, not just the information. It says, in our view, Beijing should play the role of lender of last resort to support major developers and financial institutions in trouble, and should play the role of spender of last resort to boost aggregate demand. Well, that states that clearly, Keynesian solution all the way. Just because I say it's Keynesian does not mean I'm opposed to Keynesian economic theory, or that the government in some way taking a role. It's just that is at this point the only solution that they see. It may be the only solution they would ever see, of course, but that's not a question I could answer. But anyway, so they've stated it clearly, and that's why this weekly segment has covered this issue every week for a while now. China is not the U.S., but a serious issue there will almost assuredly hurt us here. Okay, well, we've covered all that. I don't want to make this a weekly segment just on China, but it is something that is a factor. But we've got a lot of things that we look at right here at home that we need to look at now. So let's move on into the tables. Some noteworthy things to report there this week, because last week was light, just the way the reporting fell. But first, please like, subscribe, and ring the notification bell for us so that we can continue to grow the channel. So, all right, starting into the tables here. Both the Baltic and Drury, they've turned green, improved somewhat. Same with the China. Of course, this trend needs legs, but it's still a noteworthy improvement. The freight waves, that index, of course, and other transportation indexes that we happen to follow, they're really dragging bottom right now still. So they are steady and low. By the way, the 10-year spread is still making gradual progress, not significant at this point, but it's gradual, and it's well off the lows that we saw in June, so that's a good thing. Building permits are flat this week. They're not really moving much. It looks good on the table right there, but the activity is actually slowing significantly in some regions, as we're past the peak of the real estate, or the aggregate real estate cycle, and it's starting to show. So, all right, so now a big jump to the upside on this one. The Philadelphia Fed Manufacturing Index has been struggling since early in 2022, really. And I've included the graph here so that you could see what I'm talking about. So what happened with this release of data is either a miracle or this is bad data. The move up, or any move up in this index, would not and should not change direction to the extent it did. If there was a few months of improvement and then a jump, that would be reasonable, but not this radical shift when nothing really materially changed. We'll continue to watch this index the next couple months, but this is baffling, and all the rational and objective analysts out there that are reviewing this data, they're really saying the same thing. This doesn't make sense. This is a red flag. But if it is a positive move, fantastic. But it just, as you can see, does not fit the data. So moving on, I wanted to go ahead and cover some things on the second panel. The MBA mortgage application new purchase index. It's down a bit, changed a bit this week. It's not a positive move. Of course, there's some seasonality there. We'll see how this trend remains, but again, it's not great. So the average weekly claims, again, they're growing. They're continuing to grow annually, quarterly, and monthly. They were incredibly low, seemingly indicating a healthy economy. There's a lot of questions on those numbers. I've covered that before, how the Federal Reserve, in also reviewing the job numbers, showed how the BLS has not been accurate in the past, and so there's still some serious concerns. Let's talk about the U.S. auto loans delinquent by 90 days or more. There's some real talk that there's going to be some significant problems with autos because of a huge wave of inventory that's been building, and they've not been selling that inventory. So there's a lot of used cars starting to accumulate out there. Dealers are having to take some drastic measures to move that inventory. So we'll continue to appraise that. There's another index we track with that, and so we'll see what that shows us. But the M2 money supply, it's moving it actually took the edge off. So it has been trending towards shrinkage, which of course is not inflationary. It is not encouraging growth, and that's so we've had a little bit of short-term reversal, and so that may help the economy grow a little bit, but it's very little, and it's a short trend. It's only a single month's trend. The index of industrial production moved up slightly. That's a positive sign. As you can see, it's generally flat. Capacity utilization, similarly, it's moving in the right direction. Sales at retail stores, generally flat, but it's moving in the right direction. So the trend is our friend, and a few more things. So there's a lot more green. The ratio of manufacturing trade inventories to sales, down a bit. Okay, it's softer, but we have not had the robust sales on many levels. So it is understanding, and we've been seeing that in the worldwide shipping and, of course, the trucking. Change in manufacturing trade inventories. Okay, we're seeing some positive movement there. So the trend is our friend a little bit. The index of consumer expectations is down. That is because the ongoing stresses in a number of areas and credit card defaults being up. That is indicative of a lot of consumers starting to feel the pain. Going down to the Manheim Used Vehicle Value Index. Of course, it's down in the most recent publication, and it is down annually. And the reason it's moving down is because that building inventory. So anyway, so there's our three panels for this week. We've covered so much today. It appears that Forecast Friday has become far more involved than intended. And that's become more or less the norm. But that's because there's so much happening, and all of this really matters. So just a reminder, if you believe something is worthy of being on this list, please suggest it in the comments. Thanks for sharing this journey today, and until next time, ciao.